Individual Retirement Accounts, Estate Planning and Your IRA by Tony Hinson. Background: the individual retirement account quietly came onto the scene with the 1974 passage of the Employee Retirement Income Security Act, ERISA. However, the IRA was largely ignored until 1981, when the contribution criteria were greatly loosened. Despite this, IRAs remained a little watched asset for most people, and estate planners really took the IRA into account in planning for a client. This changed drastically over the past 15 years, as the assets held by IRAs have doubled to over $7.6 trillion at the market peak in 2021. In many cases, one spouse's IRA is the largest asset held by a married couple and the single largest asset held by a single person. For these reasons, the days of simply ignoring the IRA in estate planning are over. Therefore, it has become critical that estate planners and their clients understand the basic rules regarding how an IRA is passed to beneficiaries and the treatment of inherited IRAs by beneficiaries. First, the don'ts. The basic don't rules have remained the same. Do not name your estate as beneficiary. Do not use specific dollar amounts. Use fractions or percentages. Do not name your revocable trust unless the trust has been specifically drafted to hold IRAs. And do not fail to name a beneficiary, thinking your will or trust determines where your IRA passes on your death. On the last point, it is critical to complete and periodically review your beneficiary designation to make sure it reflects your current wishes. The rules pre-2020. Prior to 2020, the rules regarding passing or inheriting an IRA were fairly straightforward. IRAs were passed to a spouse, can either be rolled over into the spouse's own IRA or can be considered an inherited IRA. If the spouse elected a rollover, the spouse becomes the owner of the IRA with the required minimum distributions, RMDs, based on the same tables used for their own owned IRAs. For inherited IRAs, which include most everyone except for a spouse, the beneficiary could elect to receive the IRA at once or could elect to receive the IRA and RMDs based on the beneficiary's life expectancy. This last option became known as the stretch IRA and used a slightly different mortality table than owned IRAs, but still provided the option of a lifetime annuity. Things changed drastically in 2020. The rules post-2020. The passage of the Setting Every Community Up for Retirement Enhancement Act of 2020, also known as the Secure Act, dramatically changed the rules regarding inherited IRAs. Thankfully, the rules for beneficiary spouses remain the same. The surviving spouse can elect to roll the IRA into their own IRA or can elect to receive the IRA using their life expectancy. The changes came with the almost complete repeal of the stretch IRA options. As a general rule, non-spouse beneficiaries must take a full distribution of the IRA within 10 years of the death of the IRA owner. The IRS has proposed regulations that would provide for the IRA to be taken in continuous payments through the 10-year period, while many practitioners have called for the option to take most, if not all, of the IRA in year 9 or 10. There are exceptions to the 10-year rule. These individuals are defined as eligible designated beneficiaries and can continue to use their life expectancy to determine how fast the IRA must pay out. The most important ones are the surviving spouse, a minor child of the owner, or a beneficiary who is considered chronically ill or disabled, using definitions found elsewhere in the Internal Revenue Code. The spousal exception is useful for estate tax planning using trusts, or in the case of blended families, where the ultimate desire is to have the IRA pass to beneficiaries after the surviving spouse passes. The chronically ill/disabled exceptions are useful in that IRAs can still be utilized in special needs/supplemental needs trust planning for medical and Social Security disability benefits. In the case of a minor child of the owner, the child can use their life expectancy until they reach 18 years of age. Then they must withdraw the remaining balance within a 10-year period when they reach age 28. General considerations. Clients often ask similar questions regarding the details of IRA planning in estates. The key to remember is that the quicker the IRA pays out, the faster the beneficiary must realize the income trapped in a traditional IRA, or have fewer years in which the IRA can grow in a compounded way, income tax-free in the case of a Roth IRA. The rules are the same for a Roth IRA and traditional IRA regarding how fast a beneficiary must withdraw assets. The big difference being that the withdrawals from a traditional IRA are taxable, while those from a Roth are not. The beneficiary designation form is critical. You can name individuals, trust, charities, or in some cases, creditors. If you name an individual but later change your mind, you must change the beneficiary form. Otherwise, the individual you no longer wish to receive your IRA, example, an ex-spouse, will in fact receive the portion you previously designated. Simply updating your will or trust will not accomplish this. Charities can be named as beneficiaries, and in the case of a traditional IRA, are excellent choices. Charities do not pay income tax and will receive the entire amount without income tax reduction. Conclusion: IRAs have become an incredibly important financial planning asset, and more are the centerpiece of an estate plan. It is vital that you do not ignore them in your planning, and that you periodically check your beneficiary designation to make sure it is current. Finally, in an estate plan involving substantial IRAs, it is extremely important that you involve your entire team, attorney, CPA, and financial planner, to make sure your plan accomplishes your goals in the most efficient and tax-advantaged method possible. Tony Hinson is an estate planning and elder law attorney at Sherrard McGonagle Tizzano Lind, and can be reached at 360-779-5551.